After studying this module, we shall be able to, number 1, learn the concept of overall or combined cost of capital. Number 2, calculate the combined cost of capital or weighted average cost of capital. Number 3, know alternative weighing schemes for calculation of WACC. Number 3, learn the concept of weighted marginal cost of capital. And lastly, learn to solve practical illustrations. We shall commence the topic by studying the concept of combined cost of capital. Once the company calculates the specific cost of capital for individual sources of finance in the firm's capital structure, like the cost of debt, cost of preference share capital, cost of equity share capital, and cost of retained earnings, the next step is to calculate the company's overall cost of capital by combining all these individual costs together depending upon the weightage of each source of finance has in the firm's overall capital structure. That is the reason the terms weighted average cost of capital and overall combined cost of capital is used interchangeably. The firm can calculate the overall cost of capital for different alternative capital structures and choose the one that minimizes the cost, because the lower a company's WACC, the cheaper it is for a company to fund new projects. Weighted average cost of capital, that is commonly known as WACC, simply refers to the cost that would be undertaken by the firm on an average to raise money. The relation of WACC to the evaluation of project makes the concept of WACC a significant one. Determining an accurate cost of capital is very important, as it is used to analyze the capital budgeting decisions of a firm to see whether a future project will yield profits or not. In various capital budgeting decisions, cost of capital is taken as the key factor in evaluating and deciding the project to be chosen out of various alternative proposals that the management has. The firm naturally will choose the project that gives a higher rate of return on investments. In no case, such project would have a return on investment that will be less than the cost of capital incurred for its financing. WACC can be used as a tool by investors to take their investment decision. They can compare, for instance, if a company produces a return of 17% and has a WACC of 12%, that means the company is creating value for its investors. However, if the company is able to produce a return of only 10% as against its WACC of 12%, the company is shedding value, which indicates that investors should put their money elsewhere. WACC can also be used as a hurdle rate to assess return on invested capital, ROIC performance. The return on invested capital measures gives a sense of how effectively the funds employed by a firm are being utilized to generate returns. WACC is used as a cutoff rate by comparing it with the company's return on capital. It would reveal whether invested capital is being used effectively or not. WACC plays a key role in economic value added EVA calculations as well. We shall discuss the calculation of combined cost of capital. WACC is a way to calculate the combined cost of a company's capital that gives different components of capital based upon their proportion in the company's capital structure, instead of taking the simple average of all costs taken together. The simple average cost of capital may be appropriate because there is hardly a firm that employs equal proportion of various sources of finance. The basis of determining WACC is to determine the specific cost of each of the sources of long-term financing for the firm individually, assign weights to these individual sources of finance depending upon the degree to which the firm uses these sources, and then simply add up the weighted costs, that is, the product of individual cost with their respective weights. Therefore, following are 4 steps involved in calculation of WACC. Number 1. Calculate the specific cost of each source of fund. Number 2. Find out the weight or proportion of each source of fund in the total capital structure of the firm. Number 3. Multiply the specific cost of each source of fund with their respective proportion. And lastly, add the weighted component cost calculated in step 3 above to get WACC. For instance, think up of a company that makes use of 2 sources of financing, debt and equity. Let E be the value of all the common stock of the firm and D be the value of all the debt of the firm. We can assign value of debt and equity either on the basis of their book value or market value. Thus, E plus D must be the total value of the firm. Let KD be the after-tax cost of debt financing and let KE be the cost for the equity financing. The WACC for this firm will be WACC equals to bracket start E divided by E plus D bracket closed, whose multiplied by KE plus bracket start D divided by E plus D bracket close multiplied by KD. This equation is the same as saying WACC is equal to percent of the firm that is equity times cost of capital plus percent of the firm that is debt times cost of debt. In the previous modules on the cost of capital, we have learned the calculation of specific cost of capital for each individual source of finance. Now, next step is the assignment of weights. The weights can be assigned on the following 3 bases. Number 1, historical weights. Number 2, marginal weights. And number 3, target weights. Let us now discuss all these 3 one by one. Historical weights. These are based upon existing capital structure. It assumes that additional finance will be raised in the same proportion as the proportion of the funds in existing capital structure. It is based upon the assumption that the existing capital structure is optimum. Marginal weights. These are based upon the proportion of funds in which the new capital will be raised. It is quite logical because it is very unlikely that a company is able to raise additional funds in the same proportion as they are in the existing capital structure. The concept of historical weights and marginal weights can be made clearer with the help of following example. Suppose there is a company with its present capital structure comprised of equity and debt. Out of the total capital of rupees 50,000, debt component is assumed to be 20,000 rupees and equity component is assumed to be 30,000 rupees. Now, if the company wants to raise additional finance of 20,000 rupees, it has two options. First, it can raise the additional 20,000 in the same proportion of its existing capital structure, that is 8,000 of 40% through debt and rupees 12,000 or 60% through equity. Second, it can raise additional rupees 20,000 in any proportion without referring to the existing capital structure. If the company goes for the first option, it would have to use historical weights, and if the company goes for second option, it would have to use marginal weights. Let us now discuss target weights. Target weights are either book value or market value weights based on desired capital structure proportions. Historical weights. The historical weights can further be divided into two types: book value weights and market value weights. Book value weights. These are the weights that use accounting values to measure the proportion of each type of capital in the firm's finance structure. Market value weights. These are the weights that use market values to measure the proportion of each type of capital in the firm's financial structure. WACC calculated using the book value weights is generally lower than the WACC calculated on the basis of market value because the market value of capital component is usually higher than the book value. For instance, M Limited has following capital structure: equity share capital 25,000 shares of rupees 10 each, book value is 2,50,000 and market value is 4,50,000, 14% preference share capital, 500 shares of rupees 100 each, book value is 50,000 and market value is 445,000. Reserves and surpluses 1,50,000, 12% debentures, 1,500 debentures of rupees 100 each, book value is 1,50,000 and market value is 1,45,000. The expected dividend per share is rupees 140 and is expected to grow at 8% forever. The cost of capital is 15.77%. The preference shares are redeemable after 5 years at par and debentures are redeemable after 6 years at par. Cost of preference shares is 16.84%, tax rate is assumed to be 50% and cost of debentures is 6.66%. The WACC K0 can be calculated by using following formula. K0 is equal to WE multiplied by KE plus WR multiplied by KR plus WP multiplied by KP plus WP multiplied by KP. On the basis of book value weights, K0 is equal to bracket starts 2,50,000 divided by 6 lakh bracket closed whole multiplied by 15.77 plus bracket starts 1,50,000 divided by 6 lakhs bracket closed multiplied by 15.77 plus bracket starts 2,50,000 divided by 6 lakh bracket closed multiplied by 16.84 plus black bracket starts 1,50,000 divided by 6 lakhs bracket closed multiplied by 6.66. K0 is equal to bracket start 0.417 multiplied by 15.77 plus 0.25 multiplied by 15.77 plus 0.083 multiplied by 16.84 plus 0.25 multiplied by 6.66. K0 is equal to 6.57 plus 3.94 plus 1.665. K0 is equal to 13.572%. Internal cash in hand or retained earnings are part of equity of the firm. Therefore, cost of retained earnings is taken to be as equal to the cost of capital except in the presence of flotation costs. There are no flotation costs for the use of retained cash flows, while there are for new issue of stock. On the basis of market value weights, K0 is equal to bracket starts 4,50,000 divided by 6,40,000 bracket closed whole multiplied by 15.77 plus bracket starts 445,000 divided by 6,40,000 bracket closed multiplied by 16.84 plus bracket starts 1,45,000 divided by 6,40,000 bracket closed multiplied by 6.66. K0 is equal to bracket starts 0.7031 multiplied by 15.77 plus 0.0704 multiplied by 16.84 plus 0.2265 multiplied by 6.66. K0 is equal to 11.0878 plus 1.1855 plus 1.5085. K0 is equal to 13.782%. Under market value weights, there is no separate cost of retained earnings. It is the same as the cost of capital because retained earnings belong to equity shareholders only, and therefore it is included in the market value of equity. However, the insufficiency of the retained earnings to cover the retained equity financing will increase the WACC because a new stock issue will be needed, and this involves flotation costs which are now included in cost of capital. Book value weights and market value weights have some advantages over the other, but they are also not free from the flaws. There are some drawbacks as well for both of them. Let us first discuss the merits and limitations of book value weights. The book value weights are generally preferred by managers for calculating WACC because of the following advantages associated with book value weights. Number 1. The book value information is easily available from the company's annual report. Number 2. It is simple to use. Number 3. The capital structure targets are usually fixed in terms of book value. And lastly, it is easier to evaluate the performance of a management in procuring funds by comparing on the basis of book values. However, there are some limitations of book value weights as well, which can be discussed, like number 1. Book values are based on arbitrary accounting policies and thus do not reflect the true economic value, and 2. They cannot be justified on theoretical grounds. On the other hand, market value weights are preferred and considered to be theoretically superior to book value weights because they reflect true economic values and are also not affected by accounting policies. The other points favoring market value weights are: number 1, the sale price of securities is more close to the market value, and costs or specific sources of finance which constitute the capital structure of the firm are also calculated using prevalent market prices. But market value weights are also not free from limitations. There arises difficulty in using them because, number 1, market value is subject to frequent and wide fluctuations. Therefore, they need to be normalized first to calculate the weights, and sometimes current market value is not available easily. Marginal weights. Marginal weights refer to the proportions in which the firm wants or intends to raise additional funds from different sources without any reference to the proportion of funds in the existing capital structure of the company. The basis of assigning weights is new and hence called marginal weights. Marginal weights are better because it is new capital being raised for new investment that is important, so the weighted cost of new capital is of relevance. The other features justifying marginal weight systems are: number 1, the firm may be using some source of finance in its existing capital structure which may not be available currently. So, there is no use of including its weights for calculating the WACC. Number 2, it is practically very difficult for the firm to raise the additional funds in the same proportion as employed in existing capital structure because the current scenario might not favor the same. The reasons can be the firm's poor performance or bad state of capital market, which do not allow firms to raise capital in the existing proportion. And 2, this will give more freedom to the finance manager to raise funds after analyzing the costs and benefits associated with different sources of finance. For instance, if the new debt is available at a cheaper interest rate, the manager can finance the additional capital more through debt as compared to equity. However, marginal weights system also suffers from the following limitation. The main problem is that if we go by marginal weighing, we may resort to too much borrowing and accept many projects because of lower cost at the moment. But at a later date, the company may have the problem of raising more finance. Marginal weights ignore long-term view. Thus, the fact that today's financing affects tomorrow's costs is not considered in using marginal weights. Following points should be noted while calculating overall cost of capital. For computation convenience, it is best to convert the weights into decimal form and leave the individual costs in percentage form. The weights must be non-negative and sum to 1.0. In other words, WACC must account for all financing costs within the firm's capital structure. And lastly, the firm's additional equity stock weight MWE is multiplied by either the cost of retained earnings KR or cost of new common stock KE. Now, Which cost is used depends on whether the firm's additional equity stock will be financed using retained earnings KR or new common stock KE. We shall now discuss the weighted marginal cost of capital. Weighted marginal cost of capital refers to the incremental cost of raising additional amount of capital by the firm. So while calculating combined cost of capital, we should take the new cost of different sources of finance instead of taking their existing cost. It is the weighted average of marginal cost of each source of capital. Now let us understand through practical illustrations. Question 1. The capital structure of H Limited as on 31st March 2013 is as follows. Equity share capital having 10 lakh shares of rupees 10 each, rupees 100 lakhs. Reserves and surpluses rupees 20 lakhs. 14% debentures of 100 each, rupees 30 lakhs. For the year ended 31st March 2013, the company paid equity dividend at 20% and dividends are expected to grow by 5% every year. The current market price per share is rupees 80 and tax rate applicable for the companies is assumed to be 50%. You are required to compute A. Weighted average cost of capital using book value weights, and B. The company plans to raise further capital of rupees 50 lakhs by way of long-term loan at 16%, but this will increase the risk perception of investors and market price of equity shares will fall to rupees 50 per share. What will be the new WACC? Solution A. Before finding out the WACC, we have to calculate the specific costs of debt and equity. KE is equal to D, 1 divided by P0 plus G. KE is equal to 2 multiplied by 1 plus 0.05 divided by 80 plus 0.05, which is equal to 0.07625 or 7.625%. KD is equal to 1 multiplied by 1 minus T divided by B0. KD is equal to 14 multiplied by 1 minus 0.5 divided by 100, which is equal to 7%. Now, WACC or K0 can be calculated by using following formula. K0 is equal to WE multiplied by KE plus WD multiplied by KD. K0 is equal to 120 divided by 150 whole multiplied by 7.625 plus 30 divided by 150 whole multiplied by 7, which equals to 7.5%. Reserves and surpluses are taken as part of equity. B. New cost of equity will be KE is equal to 2 multiplied by 1 plus 0.05 divided by 50 plus 0.05, which equals to 9.2%. Cost of new 16% loan is KD is equal to 16 multiplied by 1 minus 0.5 divided by 100, which equals to 8%. New WACC can be calculated as follows. K0 is equal to 120 divided by 200 whole multiplied by 9.2 plus 30 divided by 200 whole multiplied by 7 plus 50 divided by 200 whole multiplied by 8, which is equal to 8.57%. The overall cost of capital has increased. Question 2. The capital structure of A Limited is composed of 12% debentures, 9% preference shares and some equity shares of rupees 100 each in the ratio of 3:2:5. The company is planning to raise additional capital to finance its expansion program by issuing 14% secured loan. As a result of this, the proportion of different above sources will go down by 1/10, 1/15 and 1/6 respectively. Find out the WACC of the firm given that the tax rate is 50% and expected dividend at the end of year is rupees 9 and with a growth rate of 5% per annum. It is to be noted that the new loan is not going to affect the expected dividend, growth rate and market price of shares. Solution. First of all, we will calculate the specific cost of individual sources of finance. KE is equal to dividend 1 divided by P0 plus G. KE is equal to 9 divided by 100 plus 0.05 which equals to 0.14 or 14%. Kp is equal to Pd divided by P0. Kp is equal to 9 divided by 100 which is equal to 0.09 or 9%. Kd is equal to 1 multiplied by T divided by B 0. Kd is equal to 12 multiplied by 1 minus 0.5 divided by 100 which is equal to 0.06 or 6%. Existing WACC can be calculated as K0 is equal to WE multiplied by KE plus WP multiplied by KP plus WD multiplied by KD. K0 is equal to 5 divided by 10 whole multiplied by 14 plus 2 divided by 10 whole multiplied by 9 plus 3 divided by 10 whole multiplied by 6. K0 is equal to 7 plus 1.8 which is equal to 10.6%. Now, with the issue of fresh loan finance, the expansion program, the proportion of weight of different sources will change. The new weights can be calculated as equity share capital 5/10 minus 1/6 which equals 1/3, preference share capital 2/10 minus 1/15 which equals 2/15, 12% debentures 3/10, 1/10 which equals 1/5, 14% secured loans 1/6/15 plus 1/10 which equals 1/3. Cost of 14% loan. KD is equal to 14 multiplied by 1 minus 0.5 divided by 100 which equals to 0.07 or 7%. New WACC can be calculated as 1/3 multiplied by 14 plus 2/15 multiplied by 9 plus 1/5 multiplied by 6 plus 1/3 multiplied by 7. K0 is equal to 14/3 plus 18/15 plus 6/5 plus 7/3 which equals 141/15 which is equal to 9.4%. Therefore, new WACC has decreased from 10.6% to 9.4%. Now, we shall recapitulate what we have learned so far. WACC simply refers to the cost that would be undertaken by the firm on an average to raise money. Determining an accurate cost of capital is very important as it is used to analyze the capital budgeting decisions of a firm to see whether a future project will yield profit or not. The basis of determining WACC is to determine the specific costs of each of the individual sources of long-term financing for the firm, assign weights to these individual sources of finance depending upon the degree to which the firm uses these different sources, and then simply add up weighted costs, that is the product of individual costs with their respective weights. The assignment of weights can be done on historical cost basis, marginal cost basis, or on the basis of target capital. These different sources and then simply add up the weighted costs, that is the product of individual cost with their respective weights. The assignment of weights can be done on historical cost basis, marginal cost basis, or on the basis of target capital structure. The historical weights can further be divided into book value weights and market value weights. WACC is the weighted average marginal cost of each source of capital.